This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Make no mistake, this is a repeal and a replace of Obamacare. Make no mistake about it.
An historic vote. The House passes a bill to replace most of the Affordable Care Act. Who wins? Who loses? And what happens next?
Commodity crush, oil prices plunge. Gold hits a 6-week low. Is this the weak link in the market rally?
Second Life. Why Boeing's souped-up Super Hornet is gaining renewed attention in Washington. Those stories and more tonight on Nightly Business Report for Thursday, May 4th.
Good evening, everyone, and welcome. Well, the GOP cheered, the Democrats jeered when the Republican-controlled House of Representatives passed a new version of its health care bill, overhauling, some would say scrapping, the Affordable Care Act and fulfilling a major campaign promise of the GOP and President Trump. The margin of victory was slim, but it was enough, and it caps weeks of negotiations following the failure of an earlier GOP version. In a nutshell, the bill eliminates the mandate requiring individuals to carry health insurance and some businesses to provide it. It creates age-based tax credits to help people pay for coverage. It lets states seek waivers for covering pre-existing conditions and some benefits deemed essential under Obamacare. It includes funding for those considered high risk, and it overhauls Medicaid's funding formula. House Speaker Paul Ryan applauded the chamber's vote, but said it is not a done deal yet. The legislation now makes its way to the Senate, where it may and probably will undergo substantial changes.
We still have a lot of work to do to get this signed into law. And I know that our friends over in the Senate are eager to get to work. They are. We're going to see that work through. You know why we're going to see this work through? Because the issues are just too important. The stakes are just too high.
Despite the House passage of that bill, a number of questions remain about subsidies, pre-existing conditions, and where the insurance companies stand. Bertha Coombs decided to take a look.
Congressional leaders and the White House celebrated the passage of the American Health Care Act, saying by repealing Affordable Care Act regulations, they will be able to bring down premium costs for Americans.
People were suffering so badly with the ravages of Obamacare. And I will say this, that as far as I'm concerned, your premiums, they're going to start to come down.
One of the ways the House bill does that, letting states opt out of ACA insurance benefit requirements to allow the sale of less costly plans. For insurers, that adds new complexity.
At this point, there's so much uncertainty. When you start talking about state waivers, it's not clear what the states are going to do as a consequence of that.
The bill also gives states the option of taking some high-cost enrollees with pre-existing conditions who may have to drop coverage and putting them in separate high-risk pools, providing up to $15 billion a year through 2026. Analysts at Avalere Health estimate that funding could cover about 600,000 people a year. But in Texas alone, there are nearly 200,000 with pre-existing chronic conditions who qualify. The former chief of healthcare.gov says it may not be enough.
There is this thing called invisible risk sharing, which is something that exists right now within the ACA. That $15 billion of that is dedicated to. We just don't know how big the number of states are. If there are 2 states, that probably there's more than enough money. If there's 15 states, there's probably not close to enough money.
For next year, the bill would leave Obamacare tax credits tied to premiums in place, but after that would replace them with credits ranging from $2,000 to $4,000 a year, depending on your age. The bill does not address near-term funding of $12 billion in Obamacare cost-sharing subsidies next year, which bring down out-of-pocket costs for low-income enrollees. Funding, insurers have said, is key to deciding whether they'll offer exchange coverage in 2018.
And if that gets cut off, a large percentage of them might leave the market.
AHIP, the health insurers trade group, says the industry needs certainty now on those cost-sharing subsidies. They also said that they stand ready to work with the Senate to improve the bill, starting with a recommendation that the tax credits be, quote, enhanced for those living in areas with higher health costs. Bertha Coombs, Nightly Business Report, New York.
On Wall Street, the initial reaction to passage of the bill was mixed. Health insurance stocks moved mostly higher, except for Anthem, which has some of the greatest exposure to the exchanges. Hospital stocks finished mixed, but got a slight lift on news with the anticipation that the GOP would craft its own bill. Chris Meekins is a health policy analyst with FBR and is here to talk about the potential winners and losers in the healthcare sector. You know, President Trump, Chris, said that this healthcare business is really complicated, and boy, is it ever. So I'm going to ask you for some clarity here. Let's start with the hospital stocks. If something like what was passed by the House today eventually becomes law, are they winners or losers, better off, worse off?
They're losers over the long term. So in the out years, the cuts to Medicaid would disproportionately impact hospitals. Additionally, the movement towards more high deductible health plans will result in individuals going to the hospital, having a $6,000, $8,000, $10,000 hospital bill. And what we've seen in states like Ohio is individuals are beginning to walk away from that debt. And hospitals have had to eat that bad debt, which is why names like HCA, names like Tenet, names some others in the hospital space are all going to be negatively impacted over the longer term if this becomes implemented. In the near term, you know, funding for Medicaid continues over the next 3 years. There are some additional fundings for DSH cuts is what they're called down here. So hospitals could be good over the next 18 months, but over the long term really will be negatively impacted.
And of course, we don't know what the Senate is going to do to this particular piece of legislation, but let's assume that it stays primarily the way it is now. You think some of the pharma names might benefit?
Yeah, pharma got a massive tax cut as part of the House bill, $30 billion over 10 years for the branded pharmaceutical industry. So names like Pfizer and Gilead and Eli Lilly will really benefit on their bottom line each year with hundreds of millions of dollars in tax cuts. So it's a positive for them. Additionally, not a single provision was inserted to deal with drug pricing. And that's a big deal with a lot of Americans having concern over rising drug costs.
What about the medical device makers, the Medtronics and the like?
So medical device makers will benefit in that the medical device tax, which is about $24 billion over 10 years, is eliminated. But at the same time, because hospitals oftentimes negotiate and make payments for medical devices, the downward pressure on hospitals could actually extend further downstream to the medical device and the healthcare IT companies.
Now, what do you think the fate is of this bill? I mean, there were several times where we thought that perhaps they didn't have the votes. They finally did have the votes. Are we going to see a replay of this as it goes to the Senate, do you think?
I think we're at halftime in the game. And the second half, as is the case in most playoff games you've seen, whether it's hockey or the NBA, teams tend to play a little harder when it gets serious. And so in the second half, I think we're going to continue to see these fights. I think the bill's going to be dead 8 or 9 times before it passes. But like a cat that has 9 lives, this thing has the potential to get done. And I think by Independence Day, you could see the Senate move on something.
Very quickly, we neglected to ask you your thought about the insurance companies, the big insurers that have been fleeing the Obamacare exchanges. What's going to happen to them? Quick.
Sure. In the non-group market, the names will actually get better because the tax credits, this bill benefits people under 40, hurts people age 50 to 65. The Medicaid exposed names like Centene, like Molina, could be negatively impacted if the $880 billion in Medicaid cuts go through.
All right, Chris, thank you very much. Very clear. We appreciate it. Chris Meekins with FBR.
Also on Capitol Hill, a House panel advanced a bill to overhaul Wall Street regulations. The House Financial Services Committee voted along party lines to undo the group of laws known as Dodd-Frank. Lawmakers say Dodd-Frank regulations choked economic growth and crimped bank lending. Democrats say the rules will prevent another financial crisis and protect American consumers.
Well, the drama in Washington did translate into relatively calm waters on Wall Street today. Energy stocks dropped, which capped some of the gains as investors looked ahead to tomorrow's monthly employment report. The Dow Jones Industrial Average off 6 points at 20,951. The Nasdaq rose 2, and the S&P 500 rose 1.39. That's about as flat as it gets, Sue.
You're right on that. All right, that drop in energy stocks that Ty mentioned was due to a plunge in the price of oil, which fell to its lowest level since November. That's because there are renewed concerns that OPEC may not take additional steps to reduce the supply glut. That pushed domestic crude down nearly 5%. And it's not just oil that's falling. Other commodity prices have also come under pressure in recent weeks. Bob Pisani takes a look.
On the surface, it looks like an all clear for stocks to hit new highs. Earnings are improving, and the global economic outlook is improving as well. But there's two big flies in the ointment: China and oil. China is slowing its spending on growth initiatives. They're also tightening monetary conditions, and there's talk of more regulatory scrutiny. And oil, after rising earlier in the year, has now dropped to a 6-month low. That's good news for consumers. It's not good for oil companies. You put these two together and you have a commodity rout. Oil's down 10% this quarter, iron ore's down 16%, and base metals like nickel down nearly 10%. As a result, oil stocks, as well as metal and mining companies, they're all down double digits this quarter. Not surprisingly, analysts have begun taking down earnings estimates for oil companies. As a result, we're starting to see oil stocks show up on a 52-week low list. Schlumberger and Occidental Petroleum and Apache and Murphy and Range Resources all join the list today. How big a problem is this for the overall market? For the moment, stocks remain favorable. Traders are still betting the improving global economy will trump the oversupply of oil, and many are betting that the Chinese will back off from their recent slowdown as we get closer to October. That's when the Chinese leadership is scheduled to turn over. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Still ahead, the retail wreck. Why it's not just the shift to online shopping that is leading to a rise in brick and mortar bankruptcies. Late today, CBS saw its ad revenue drop, though its profits topped expectations. The network was helped by higher content and subscription fees. The company has been focusing more on its streaming services as more and more advertisers follow viewers online. And the big concern for the industry broadly is the rise in cord cutting, meaning a growing number of consumers who no longer want to pay for cable TV. And one way or another, cable television subscription fees work their way back to content providers, station owners, and networks like CBS. Julia Borston has more.
The pay TV business suffered its worst first quarter ever, according to a new report from MoffettNathanson. Even if you account for additions from smaller skinny bundles such as Sling TV and DirecTV Now, analyst Craig Moffett says the pay TV business still lost about 500,000 subscribers.
It's not that these customers are leaving and going to virtual over-the-top players, because those guys were weak too. And so the content category was also down by about 1.5%. And remember, for any individual content player, they're doing worse because they're not included in every one of these packages.
Viacom echoed those concerns today. CEO Bob Bakish acknowledged some softness in subscriber numbers for the quarter, saying the fact that some of its most popular channels are not included in a popular skinny bundle is having an impact. And there are growing concerns about advertising, that ad pricing gains may not be enough to offset ratings declines. Time Warner's Turner reported a 2% drop in ad revenue, its weakest first quarter in years. And Viacom reported a 1% decline in advertising in the quarter. But at the Milken Global Institute conference Wednesday, ahead of earnings, CBS CEO Les Moonves was bullish about both advertising and about CBS's role in the changing TV landscape, saying that CBS and its content are everywhere, from its own CBS All Access service to skinny bundles and over-the-top streaming services, like Hulu's new bundle, which just launched this week.
We think it's the wave of the future. You have to be everywhere. No matter how you want to get your content, we're going to be there for you.
With Disney reporting earnings next Tuesday and Fox reporting next Wednesday, we'll see if those media giants can reassure investors. For Nightly Business Report, I'm Julia Borston in Los Angeles.
The media industry isn't the only one going through a transformation, so is retail. 2017 is on track to be a record-setting year for bankruptcy filings and store closings. But if consumers are, by many measures, spending, why are the retailers hurting so much? Courtney Reagan explains.
Retail may be at a tipping point. More shopping is shifting online in general and to Amazon specifically, which is hurting store sales. Consumers are spending more on travel instead of clothing and investing in their homes rather than adding to their closets. The shifts have been happening over time, but after the recession, mall landlords gave concessions like lower rent or better lease terms, hoping to prevent ghost malls. Several years later, as retailers weakened, private equity firms stepped in, injecting cash to help prop them up. Those PE owners provided the financing, but the interest payments on the debt is due now, which is the ultimate reason many of these retailers are closing for good. In fact, half of the retailers filing for bankruptcy this year are highly leveraged with debt from private equity, including Payless, The Limited, and Wet Seal.
It's no different than a consumer who maxes out his credit cards. Once you've maxed out your ability to borrow, your degrees of freedom, if you should encounter any sort of a crisis, are much, much fewer and much more far between.
The debt strategy works when sales are going higher, but as sales fall, there's not enough cash to pay back what's now due. Making matters worse, as retailer sales begin to fall, some private equity firms want to make sure to get their money out, so they add even more debt, requiring the retailers to pay them special dividends.
I think what you're looking at is really death by 1,000 cuts. They just have less margin for error. So anytime there's a little bit of a dip in the business, it gets harder to pay their interest and it gets harder to satisfy the rest of their obligations.
And now there's less time to figure it out than in the past. Because of major changes to bankruptcy laws in 2005, retailers now only have 210 days max to decide which stores to close and how to restructure to emerge from bankruptcy. Prior to the law change, it wasn't uncommon for a retailer to need 18 months to emerge from bankruptcy with a healthier business. All of it together means highly leveraged retailers filing for bankruptcy now turns into liquidation and not reorganization much more frequently. For Nightly Business Report, I'm Courtney Reagan.
Anheuser-Busch InBev brews up some profits that clear the bar, and that's where we begin tonight's Market Focus. The world's largest brewer said its better-than-expected earnings were largely helped by the integration of rival SAB Miller. AB InBev also said strong sales of its pricier Stella Artois and Michelob Ultra beer helped offset declines in Bud Light and Bud, the king of beers. In addition, the company said it is starting to see improving beer volumes in Brazil, its second largest market. Shares rose 5% to $119.47. Adidas reported higher than expected earnings and revenue as the German sports apparel company saw strong online sales and some pickup in its Reebok brand. The company also confirmed its guidance for the year, and the CEO said he's happy with the latest results.
We've built really a very strong pipeline over a set of years with a very clear view on where we're going to take the brands. And as you can see, America grew more than 30%. Our Adidas business in America grew 36%. In China, we're growing 31%. So in the two biggest sports markets in the world, we're by far outgrowing the market.
Adidas shares rose fractionally to $183.80. Cost cuts helped Kellogg post a higher profit that topped estimates. The maker of Rice Krispies and Pop-Tarts did see overall sales fall, though, as weakness in the company's North American and European markets hurt results. Still, Kellogg finished up 2%, $70.40.
Avon swung to a surprise loss as lower sales in the U.S. and some foreign markets impacted their results. The cosmetics company also posted revenue that came in below expectations and says it sees sales growing in the low single digits this year. It was not a pretty picture. Shares plummeted 22% to $3.62. The burger chain Shake Shack posted earnings and revenue ahead of estimates, but the company disappointed with its weaker-than-expected same-store sales. The company cited softer foot traffic and cold weather during the quarter for that miss. Shares initially fell in after-hours trading and also ended the regular session down more than 2% to $33.12.
You may have heard about the scam spreading through Gmail yesterday, a legitimate-looking email that if you clicked on it could steal your personal information. It had a lot of people worried. Andrea Day now on what you need to know.
Call it a classic phishing scam. If you opened your email, it looked like a friend or someone you work with was trying to share a Google Doc. Our producer got two, and here they are. But it was just a trick. Cyber criminals were trying to steal your information by fooling you into opening the document. If you did, you were asked to give permission for it to access your account. And from there, it went out to all of your contacts. Right now, it's not clear what kind of information attackers wanted to grab. But Google says only about 0.1% of Gmail users were compromised, and the bad guys were shut down within an hour. So what does that mean for a company like Google?
The fact that Google is so big, they were able to see and take action on it pretty quickly. Anytime you offer services to the internet at large, there could be vulnerabilities, and that's usually involving tricking users to compromise themselves.
And according to Google, even if you fell for the attack, there's nothing you need to do right now. You can always check out any apps that are connected to your account by going to Google Security Checkup. But experts say it's always a good idea to keep changing your password and don't click on anything unless you're 100% sure. For Nightly Business Report, I'm Andrea Day.
Coming up, a battle for the sky.
I'm Morgan Brennan in St. Louis, Missouri. This EA-18 Growler is part of Boeing's F-18 fighter jet family. We're going to talk about the future of the F-18 program and the fight for defense dollars coming up on Nightly Business Report.
Apple is investing in advanced manufacturing jobs. In an interview with CNBC, CEO Tim Cook told Jim Cramer that the company is creating a $1 billion fund aimed at bringing those types of jobs here to the U.S.
It's $1 billion of our U.S. money, which we have to borrow to get. That's another whole topic. But yeah, we're really proud to do it. And by doing that, we can be the ripple in the pond, because if we can create many manufacturing jobs around, those manufacturing jobs create more jobs around them, because you have a service industry that builds up around them. And we'll be announcing the first investment from this fund later in the month of May.
Mr. Cook said Apple has already created 2 million jobs in this country, and as we reported earlier this week, Apple has a cash pile of more than $250 billion.
The U.S. military is in need of fighter jets, and the battle to fill that demand is heating up. Morgan Brennan is at Boeing's F-18 production line in St. Louis.
It's been the backbone of naval aviation for 4 decades, and now F-18 is getting a second life.
We've always thought that the Navy buying additional Super Hornets made sense because they need airplanes to last out in the 2040s.
Earlier this year, the Navy disclosed that 2 of every 3 of its F-18 fighter planes are out of commission, awaiting repairs. They've been flown hard in a post-9/11 world, which, coupled with maintenance backlogs, has resulted in a serious fighter jet shortfall. This EA-18 Growler is the jamming plane outfitted from the Super Hornet. Both are part of the F-18 fighter jet family, and both are assembled here in St. Louis. Boeing says it's ready to make more.
Today we're producing 2 ship sets per month, Super Hornets and Growlers, in this factory. As we think about the U.S. Navy's demand for additional airplanes to address Super Hornet shortfall and other international demands, we could see that going back up to 3 or 4 per month by sometime in the early 20s.
The 2017 budget includes a $1 billion allotment for 14 new Super Hornets, and Boeing expects the Navy to buy at least 100 more through 2022, a move that would ensure FA-18's dominance on aircraft carriers for decades to come. It's also rolling out a program to extend the service life on the hundreds of planes in use, and working on a new version for future orders.
The Block 3 now is going to keep us several steps ahead of what we project as the future threat.
After a 20-year career with the Navy, John Toonces Tugas test flies Super Hornets as they come off Boeing's assembly line. He says evolving enemy capabilities make it imperative future F-18s have more advanced capabilities. The reason Boeing is proposing this new upgraded Block 3 Super Hornet.
So the whole idea is not to be able to just win today's battle, it's win the future battle. Because an aircraft has to be, have the capabilities to stay ahead of the threat, of the future threat.
Boeing argues that the administration should buy more of these Super Hornets and less of the price your F-35s made by rival Lockheed Martin. a strategy it has claimed would save the Pentagon tens of billions of dollars. Still, analysts say the Navy will need both strike fighters in its air wing, even as competition for future defense dollars heats up.
Well, the F/A-18 is the legacy fighter, and the F-35 is the new fighter. So I think, as you would expect, the new fighter is going to have some improvements over the legacy fighter. It's going to be stealthier. It's going to have a longer range. But those factors come at a price. And I think President Trump has made it very clear he's looking for the lowest price possible.
The Super Hornet currently costs about $75 million. An advanced version will add $3 million to the price. By comparison, the naval variant of the F-35 is about $120 million. But whatever the final mix, the Navy and the contractors involved say the planes will ultimately complement each other, enabling the military to better keep America safe. For a Nightly Business Report, I'm Morgan Brennan in St. Louis, Missouri.
And finally tonight, May 4th is Star Wars Day, as in May the 4th be with you. A day to celebrate one of the most successful franchises in entertainment history. The first movie was released in 1977, and since then, worldwide gross at the box office more than $7 billion. According to Fortune, DVDs, digital downloads, and other home entertainment sales reached nearly $6 billion. Toys and merch, $17 billion. Video games, more than $4 billion. And then there's all the other stuff, like intellectual property, books. They took in more than $3.5 billion for a total of nearly $42 billion.
I think we both have some of those toys in there.
Oh, yeah.
Yep. That'll do it for us on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Have a great evening, everybody. We'll see you back here tomorrow.